Trying to predict interest rates can really be a tremendous waste of time. You can see here market forecasts are almost always wrong about the future path of the Fed's fund rate. So at different points of time, you have all these estimates as to what the Fed funds rate is going to be, and most of the time they're wrong. And throughout since 2008, as this graph shows, it's very difficult to predict the Fed funds rate. Trying to predict anything is next to impossible. Now, William O'Neill, who was the founder of Investors Business Daily newspaper, one trait that he had was that he was very, very flexible. And O'Neill frequently emphasized that rigid traders break while successful investors remain flexible and let the market dictate their outlook. William O'Neill would be willing to change his mind very quickly, and I think that's really a positive. Now, the latest thing of these prediction markets, one thing about Wall Street that I've learned over the years is that there's always a gimmick. Whether it's, options or mutual funds or ETFs or prediction markets or Bitcoin, whatever. But, P.T. Barnum said there's a sucker born every minute. So these products come out, and I really kind of think you need to be very wary of them. Only 1 in 4 Americans think now's a good time to invest. This is showing sentiment. As we've been saying over the last couple of weeks, people are awfully pessimistic. There's not a lot of optimism out there. Now, when you have a stock market bubble, optimism is through the roof. Now, one thing about the ego is that 70% of the people think they are smarter than average. Statistically, most of them are wrong. The stock market doesn't care about your ego. The second you think you're a genius, the market will take your lunch money. In other words, you have to humble yourself. You have to realize that the market is an auction market driven by millions of investors throughout the world. So there's no way to really, predict it. Therefore, using technical analysis really does help with that matter. Now, speaking of technical analysis, small caps have had the best start since 1991. You can see here that the small cap stocks are breaking out and making new highs. Now, realize now, for the last 5 years, the market has been dominated by these very large companies, mainly the Mag 7. And so for the first time since 1991, we're starting to see the small caps breaking out. Now, we're going to look at some indexes to try to see this broadening out process. Now, you can see here with the NASDAQ, we continue to have basically nothing more than sideways action here. We made the high back at the beginning of June. We came down, held the 50-day, rallied, then somewhat failed, broke down below the 50-day. Now we're trying to rally again. So the point about the NASDAQ is it's kind of become the lagging index of the group, because if you look at the mid caps, just like the small caps, we're starting to see a broadening out where these group of stocks are starting to make new highs. Here's the New York Stock Exchange. It actually made a new high today. Now, there's a lot of financials in this particular index. There's a lot of oil stocks in this index. So it's not really a growthy index, but it does show you that things are changing. Here's the S&P 500. Just like the NASDAQ, the large cap stocks are starting to have difficulty. So you've got your top, your lower top, and then you got another lower top. So just be aware of the fact that the market appears to be broadening out. Now, on the aggression index, again, we're having somewhat of a bounce here, somewhat of a recovery. We're back above that 50-day moving average. So the aggression index is looking a little better, but not as strong as I would like. Now, when it comes to interest rates, things have been somewhat stable. We've got the 5-year Treasury here lingering around 4.2%. We're still up about 15% over the last 125 days. The chances of the Fed cutting rates are pretty low. In fact, there's a lot of talk about actually raising rates, the Fed funds rate. But we can't predict that because it's next to impossible to predict it. Here's the primary trend, which is the 200-day moving average, which is a very important moving average. The S&P is in an uptrend. The primary trend is up. NASDAQ is in an uptrend. So, we don't see any real terrible market conditions. We just feel that here in the short run, we're kind of having some difficulties. Price of oil continues to plummet. We're down below $70 a barrel. If you really think about it, we're back down to the same levels that we were at when the Iran war got started. Now on new lows, we're continuing to see elevated new lows, which means that the sellers are pretty much dominating the market right now. We're not seeing a lot of strength in any of the indexes. We're finding individual stocks very difficult. We're not finding very many. So the new lows are a little troubling. I did want to mention, though, that the transportation index has actually been hitting a new high as well. Now, this is a very positive sign. We're talking about truckers, railroads, airlines. And so when you've got this particular index hitting new highs, that's a very positive thought about the economy. Now, SpaceX, we've been talking about SpaceX, came out at 135, ran up to 225. We're just kind of watching it for the heck of it. It kind of broke out somewhat here above this little base. However, pulling right back down into the base. So like I've said on IPOs, be patient, wait for the right setup, and we just don't have that yet. So if you have any questions, please let me know. Thank you very much.